Welcome back to another edition of Westwood's Multi-Asset Monthly. My name is Ben Chittenden, and I'm a portfolio manager and research analyst on the team. So the month of April was certainly eventful. The markets were on a roller coaster ride post-Liberation Day as the world digested what the implications could be. Let's start off with realized volatility. What we're looking at here is the volatility of the S&P 500 over the prior 20 days. 20 days is a month. So we're looking at basically a monthly metric of trading days here. What we see is that the volatility was the highest we've seen since COVID. At one point in April, the S&P 500 was down 11% for the month and down 19% from the February highs. What's really interesting overall is that from a 40,000 foot view, the market didn't really change all that much for the course of the month. The S&P 500 ended up only being down 75 basis points for the month. And so far in May, it's up 5%. So not only have we fully recuperated the Liberation Day sell-off, we're now trading higher than we were before it. If we flip over to interest rates, the 10-year yield for the month overall moved from 4.21% to 4.16%, despite being as low as 4 and as high as 4.5. If we look at credit spreads, it's a similar story. Investment grade credit went from 93 basis points to 106. High yield widened from 345 to 384, but during the month, high yield spreads peaked out at 450, so substantially higher than where they closed. So far in May, investment grade spreads are back down to 94, so basically flat to where they were at the beginning of April, and high yield spreads are back at 305. So just like equities, high yield spreads are now tighter than where they were before Liberation Day. The main asset classes that are still lower are commodities, and here we're just using the Bloomberg Commodity Index as our proxy. It's off about 4% since April 1st, and the dollar's down a little under 3. So despite all the volatility and bearishness during the month, the only thing that these markets are suggesting at the end of the month is that growth will be slower, but not recessionary. Now, with all that said, we as a team weren't sitting still throughout the month. We did make some changes to the portfolios, and we wanted to give a small sense of our thought process in terms of how we deal with large moves like we saw. There are two critical assumptions that I'll start with. First, as you've heard in these videos over the months, and in this video you'll hear as we continue, we think about the world probabilistically. We talk a lot about repeatable processes, and you can see an example of that each month in the CMOs that we put out. Second, normally we can monitor economic variables to get a sense of where we are in the cycle and to have a better sense of the underlying probability shifts. Now, that's in most normal situations. Obviously, April wasn't a normal month, so we needed to adjust how we think about probabilities. Now, one of our backup mental models is to think through the known unknown matrix. That's what's on your screen right now. This is the matrix where we can think about 4 quadrants. These are kind of known knowns, so these are facts that everyone's aware of. Known unknowns, these are questions. Unknown knowns, more like intuition, and then unknown unknowns. These are just unknowns. It's a much cruder form of assigning probabilities. So there are implications to how much risk we'd want to put on in the portfolio, but it's at least a way for us to think through what could move markets and what the potential impacts could be. Now, when we think about what were some of the known unknowns, so the biggest questions that we had over the course of the months, the first is, would there be some kind of delay to tariffs, to the implementation of these tariffs? Our thinking was that this would show a desire to negotiate and would be viewed positively. When we saw the announcement on April 9th, we did get a little bit more comfortable and added a little bit more equity exposure back to the portfolio. The other main known unknown, so again, the other main question, was could all of this be just targeting China to force an irrevocable change? If it was, then this would obviously drag on for a while. And if it wasn't, it was obviously just a negotiating tool for a deal. And in theory, we'd be able to lower tariffs quicker on China. What we saw this past weekend, the 90-day delay, and the substantially lower tariffs suggest that the probabilities are shifting towards deals with China and not some kind of irrevocable change. And this obviously is a positive. So again, just to recap, when we shifted our probability framework, we reduced some of the equity exposure as we couldn't really assign probabilities the same way that we normally would. We felt comfortable enough with the mental model of the known unknown matrix to assign crude probabilities. And then we felt that certain events had transpired that put those probabilities for better outcomes in our favor. And so we added back some exposure. And that's just a quick glimpse into how we manage the portfolio on an intra-month basis. As always, if you have any questions, please feel free to reach out to us. We'd love to hear from you. I hope you've enjoyed this video. You've gotten a little glimpse of how we think about portfolio management here at Westwood, and we'll be back here next month with more.